Hey there, Washington public employees. You've worked hard your entire career. You've saved and saved and saved. And now it's time to start pulling money from those savings and investments. How do you do that in a way where you're not going to be running out of money? You're doing it in the most tax efficient manner and ultimately not leaving Uncle Sam a tip. That's what we're going to get into in today's video. We're going to look at how do we pull money from all those hard years of savings and do it in the most tax efficient way. My name's Seth Deal. I'm a CPA and financial advisor with Life Focus Financial Advisors. I'm a former city employee and I absolutely love helping public employees plan their financial futures. Let's face it, taxes are one of the biggest expenses that you're going to pay in retirement and throughout your entire life for that matter. But what we want to do is we want to liquidate our investments. We want to pull money from our investments in a sustainable way that's also tax efficient and ensures that bottom line dollar that ends up in your pocket is as large as it can be. The first point that we want to talk about is if you're living in Washington, if you're a Washington State public employee and you're planning on staying in Washington, Washington doesn't have a state income tax. If you're planning on moving to another state, considering relocating, keep that in mind that Washington doesn't have a state income tax. However, with that in mind, Washington does have other taxes and costs and in some areas a high cost of living. So kind of keep that in mind as you're planning for retirement. Washington doesn't have a state income tax. However, if you're moving to a lower cost of living area and it has a state income tax, that could be offset a little bit. Now what we want to do is we want to develop what I like to call our retirement income tax map. And what this means is we want to map out and identify all the different income sources we have and how those are going to be taxed. And then we want to start thinking about, well, how do we pull money out of those in a tax efficient way each year and ensure that we're getting the most in our pockets. Ultimately, each income source potentially has different tax treatments. Let's start with Social Security. So if you've paid into Social Security, so excluding anyone who is not paid into Social Security, so if you're a firefighter, for example, that is not paid into Social Security, this won't be applicable. However, you might be married or have a spouse that did pay into Social Security and maybe you're getting a spousal benefit. So this is something to be aware of. Social Security is taxed at ordinary income rates, potentially up to 85% of those Social Security benefits are taxed. So keep in mind, depending on your income level, they may not be taxed at all. They may be taxed at 50% or they may be taxed at 85%. Then we have your pension. Your pension is taxed at ordinary income rates. Ordinary income rates are the worst type of income to have. However, they're the most common. Those are going to be taxed anywhere from 0 to 37% depending on your tax bracket. So keep in mind with ordinary income rates that even if you're at, let's say, a 22% tax bracket, not all of your income is going to be taxed at 22%. Some's going to be 0, some's going to be 10, 12, 22, 24, and so on. Since we have a progressive tax bracket, not all of your money is being taxed at 22%. We then have any tax-deferred savings. Tax-deferred savings is something that we put away during our working years and got a tax deduction for it. So we were able to defer those taxes to later years when we eventually start pulling money from those accounts. So that's going to be a 457B deferred comp. If you're on a Plan 3 investment option, that's also going to be tax deferred. And then any 401ks, IRAs, anything where we got a tax deduction today. So when we take those tax deferred savings and we start pulling those out, those are taxed at ordinary income rates. The next stop on our tax map is our tax-free or our Roth type accounts. So that's going to be any Roth IRA, Roth 457B, anything where we paid tax today in exchange for tax-free growth and being able to pull out those contributions tax-free. I also like to lump HSAs into the tax-free bucket in addition to our Roth accounts. We then have our taxable bucket. So if you opened a brokerage account, picked some stocks, bought some stocks, and then when you go to sell those stocks, those are going to be taxed at anywhere from 0, 15, or 20% capital gains rates. And that's just going to be taxed on the growth. Your original contribution, you get to take that out tax-free. But that growth is taxed at capital gains rates, which generally are more favorable than our ordinary income tax rates. However, they're not quite as good as the tax-free rates. So our kind of three buckets are our ordinary income bucket, which includes our tax-deferred savings. We have our tax-free bucket, and then we have our taxable bucket. So those three components play an important role in understanding your retirement income tax map. Now that we have a good understanding and background from a tax perspective and how your savings are ultimately taxed in retirement, we can then figure out how do we pull that money out in a tax efficient way where we're ultimately putting the most amount of money in our pockets that we can. A couple key reminders that we want to be aware of. Required minimum distributions, RMDs, start at 73 and eventually they'll go up to 75. RMDs are required distributions on those tax deferred savings. Basically what the IRS says is you can't keep that money in that tax deferred account forever. At some point the IRS wants their cut of your tax deferred savings. They don't want you to defer that forever. Then what I generally like to do with my clients is I like to balance out their taxable and their tax deferred distributions. We can adjust those each year to ensure that clients aren't paying more in taxes than they potentially need to pay. One of the strategies we like to do is called a Roth conversion, where we're converting some of that money, that tax deferred money that you're not planning to use, and we pay the taxes with the taxable account as well as live off those taxable savings and ultimately allow you to move money from tax deferred to tax free in a way where you're not paying more tax than you need to be. We then like to leave our Roth accounts for as long as we can because we want to take advantage of those tax-free growth opportunities. However, the great thing about Roth accounts is, let's say you have a big expense that needs to be paid, or let's say you're doing something fun. Hopefully it's something fun, like buying an RV and taking a trip across the country. Well, you can use that tax-free bucket to make that happen without having to pay extra tax. So keep in mind that we generally want to go taxable, tax deferred, some combination of those, and then we want to let our tax-free bucket grow as long as we can. Let's now get into some high-level overviews of some more advanced tax strategies that you can pursue. So, for example, one of the things we often try to do with our clients is we try to put off taking their pensions and Social Security a year or two if possible. And what that allows us to do is it allows us to create a low income year where we can then take advantage and do some of those Roth conversions and other more advanced planning to ultimately help our clients not pay more in taxes than they need to. One of the other strategies to be aware of is once you reach the age of 70 and a half, you can give to qualified charities through what's called a qualified charitable distribution tax-free. So you can give money directly from your traditional IRA account. It can't be from a 401k, a 457b, it has to be directly from an IRA. So keep that in mind. You have to give directly to the charity from the IRA. You can't give out of pocket and then get reimbursed, like let's say an HSA. It has to be directly from the IRA. And those are called qualified charitable distributions after the age of 70 and a half. Ultimately, what we want to do when we're figuring out how do we pull money from our savings in a tax efficient way is we want to coordinate all of our income streams, all of those moving parts, and we want to understand how those all come together so that ultimately we can figure out how do we pay for our expenses in the most tax efficient way we can. One of the things I encourage my clients to do is look at your pension and your Social Security as your fixed income bucket that's used to pay all of your essentially day-to-day living expenses, all of your normal living expenses, and then use your supplemental savings to do those fun things and to enjoy retirement. At the end of the day, we want you to be enjoying your retirement, getting the most of those years, because at the end of the day, you only get one retirement. Thanks for tuning in to this video. If you want to learn more about potentially working together, go ahead and head over to lifefocusadvisors.com. I also have a free guide available in the description called 7 Money Mistakes and I commonly see these being made, and I want you to avoid those. So be sure to check out that guide in the link below.